Hi, I'm Roger Montgomery from Montgomery Investment Management, and welcome to this week's video insight. Well, predicting market direction is a bit of a mug's game, and we're not going to try and do that for you today here. What we will do is present some facts and leave you to decide. This first chart is a chart of the Cape-Shiller ratio going back to 1870. It's effectively a PE ratio comparing the inflation-adjusted S&P 500 to 10-year average earnings. And what it shows is that the market is expensive at a level of 32. In fact, going all the way back to 1870, there's only been one occasion where the market was more expensive, and that was during the tech boom of 99 and early 2000. Now, this indicator is not good at predicting corrections, but it's very good at predicting the next 10 years annual returns. And so we've put returns in at various points along the Cape-Shiller ratio. You can see whenever it's high, the future returns are low, and whenever the index is low or the indicator is low, future returns are much better. Now, the question is, if low returns are likely to ensue, will those returns be accompanied by higher or lower volatility? This next chart is a chart of the 12-month annualised Sharpe ratio. Now, to put this in context, if a fund manager was to generate a 10% return with 10% volatility, that would be a Sharpe ratio of 1. If they delivered a 20% return with 10% volatility, that would be a Sharpe ratio of 2. The S&P 500 has recently delivered a Sharpe ratio of 9. That's without any active management at all. You can kind of understand why so much money has flowed into ETFs, exchange-traded funds that track the index. But what this chart actually shows is that you have to go all the way back to 1958 to see a level that we've seen just recently. And we can also see that it tends to mean revert, meaning that we're likely to see higher volatility in the future and lower returns. Now, that's all happening at the same time that this chart shows a record amount of money flowing into index ETFs, particularly tech-related index ETFs. And this is the PowerShares QQQ ETF, which is arguably the most popular ETF to follow the NASDAQ 100. But just as a maximum amount of money, $3.5 billion the week of March 16th, was flowing into index ETFs, particularly technology-related ETFs, bond investors, corporate bond investors particularly, were exiting stage left. And in this chart, you can see a significant spike in the spread between corporate bonds and US Treasury bonds, meaning institutional corporate bond investors think the risk is going up and they're demanding a higher return from companies, just at the same time that record amounts of money are flowing into equities. This next chart shows the amount of leverage in the US stock market. This is tracking, these two charts are tracking the absolute amount on the left-hand side and the growth rate on the right-hand side of margin lending on the S&P 500. And what you can see is that we're at record levels and very strong rates of growth, which often coincides with a near top in the stock market. And finally, it doesn't really matter whether or not we're predicting the market to go up or go down. If there's more volatility, this final chart shows that as volatility increases, or as fear or risk increases on the horizontal axis, the multiple of earnings investors are willing to pay falls. In other words, they want higher returns to compensate for the extra risk, and so are demanding lower prices. I'll leave you with those thoughts. We look forward to talking to you again next week. In the meantime, continue to follow us on Facebook and Twitter with our thanks.